So welcome, my name's Scott Parry. I am the money master. Why do I say that? Because I've helped more people than anyone else in Australia pay off their house. I'm lucky enough where every 24 days I get to pick up a phone and say, congratulations, you paid your house off today. So I don't know anyone else in Australia who can say that they're doing that every 24 days. It's the best part of my job, to give someone the freedom of not having a mortgage payment. Everyone reacts differently when I give them that news. Some people want me to cross-check the numbers. Other people sort of start crying, happy tears, obviously. And others are just saying, I feel lighter. I had a client last week who he was a little bit overweight, and he said to me, Scott, I feel 50 kilos lighter just because of this. And he sort of was saying, it's, those prisoners that when they get released from jail and they walk out the gates for the first time back into the real world, he said, I feel like they would feel like that freedom of, wow, okay, now we've got all the world ahead of us, so many opportunities for doing things that we love, which is spending time with our family, traveling, experiences. I always ask my clients, what are you going to spend the money on now? You've got a pay rise of $2,500 per month. And whatever your mortgage payment is, that's the pay rise that you get once you pay your house off. And so it's life-changing to get a $3,000-$4,000 pay rise every month. And what you do with that money, I always say that we should invest half of it. We should play with half of it. So it's a win-win. But yeah, that's what we're going to run through is everything these clients have done over these past 23 years to pay off their house on average in 12 years. So that's our average. Some clients we've got paying off in 4 or 5 years. Some clients we've got paying off in 15 or 16 years. Our average is 12 years. And so we're going to run through all the data there, tell you guys what you could be doing better to optimize it. But more importantly, we're going to go through your numbers and your facts and your figures. So I want to kick off. I'll bring up the presentation, and then from there we can actually start to get into the nuts and bolts of this, because it's all well and good. I'm sure there's a lot of people out there who are sort of saying, yeah, well, if it was this easy, why isn't everyone doing it? It's a really good question. My answer to that, you'll start to see here. The reason why not everyone is doing this is because there are vested interests that we need to take into account. That vested interest, prime example, is the banks make more money the longer you're in debt. Wow, what a surprise. And so when we're looking at banks, they're the ones who are designing loans and how they're structured. And by default, those loans are designed to keep you in debt for as long as possible. That's the name of the game. Everybody makes more money the longer you're in debt. And if I was to be honest with you, it's just like going to McDonald's and asking them for nutrition advice. I don't know. Don't think McDonald's want you to be that fit, but this is what we can do. This is not financial advice. I was financial advisor for 13 years. I'm talking cash flow, debt reduction, equity creation, and pay off early systems. So no more mortgage payments every single month. Everyone's obviously different. You know what your mortgage payment is, and just think of it as a pay rise. When you pay your house off, you get that as a pay rise. That extra income to you is life-changing. And what you can do with that with your family and friends and experiences, as well as what you can do to boost your actual asset base, is phenomenal. So the power of that income is what we want to get back in your hot little hand where it belongs. Stop paying to the banks. They've got enough money. CBA made $10,000 million net after all expenses last year. That's a huge amount of money. They know all the tricks, all the loopholes. They've covered everything. But what we want to do is pay our house off as fast as we possibly can. What does that look like? That looks like mortgage Freeman. And so what this really does is gives you a perspective of, I know it doesn't seem like probably realistic at this point in time. So many people think of just everyone's got a mortgage. That's just the way it is. It's not, doesn't have to be. It is the way it is if you keep doing what you're doing, because I think you and I both know, looking at your numbers, things aren't moving as quickly as what you'd hoped. And so most people I'm speaking to, and this is over 2 decades of experience, seeing 6,500 Australians in financial positions, I would say most Australians are frustrated by their lack of financial progress. And if that's you, you've been working your guts out, you can't work any harder than what you are, but nothing seems to be moving financially. And that for a lot of people is the frustration of like, what else can I do? We're about to go through this. Why listen to me? excellent question. You should never take advice from anyone who is poorer than you or not in a financial position you want to be in. So personally for me, I started this company when I was 20 years of age, over 20 years ago. And since then, I've just basically mastered a system and a strategy that's going to help you pay off your mortgage early. I've personally acquired 10 investment properties from now, sort of at that point where lucky enough don't need to be working, and I'm just now focused on how many people can I help. That's my get out of bed reason, is to be able to jump on a call with someone, say you paid your house off today, see the grin on their face. You can see a few of these people, and just like to shift someone's life like that. If you just that for one person, you've had a great life. I'm lucky enough I get to do that every single month. So featuring every newspaper, TV station, magazine, all the stuff around the country, they're all journalists hitting me up saying, Scott, what are you doing differently? Why is this working? How is this working? And so that's what we're going to run through tonight. So average client sits down with our team, they're saving 3.5%, 3.7% of their income. What does that mean? Let's pretend they earned $100. They're spending 96.3% of that, okay? They sit down with us, we plug in the right structure and strategy on this payoff early system, and now they're saving 17 cents in every 100 or every dollar, $70 in every 100. So rather than actually spending 96.3 cents or dollars, they're actually now only spending 83%, which is a lot better. How do we do that? The same income, same loan amount, how do we get such an increase? There is about 10 things which we implement, which we're going to run through with you tonight, exactly what we can do to help you get out of your loan faster. My average client pays 28 grand off their home loan. Before joining me, same income, same loan amount, they're paying 10,000 off their loan. That's an average. I've got clients paying over 100,000 off their mortgage in 1 year. And so that's the average. We've got some clients paying 14, some clients paying 20. The average trainer is doing 10. So over the years, our clients have got a 200% better result financially in terms of their debt reduction, how much equity they've created within the first 90 days of working with us. So all I'm about is helping families set up automated financial systems so you can do what you do best, which is earn money and spend it. Everything else is taken care of. A lot of reviews, I'm sure you've done some due diligence. I'm sure you've checked out the Google reviews. Haven't worked out how to fake them yet. So we just do what we say we're going to do. I mean, you can't be in business for 23 years and let people down. Like, the word gets out there. So we're just about paying people's mortgages off as fast as possible, teaching them what they need to do to be able to assist in that. And at every single step of the way, tracking their numbers. It's everything. If you're not tracking it, I don't think you care. And so if you're trying to lose weight, you need to set of scales. Pretty obvious. I think financially, no one's got a set of scales. I've asked every single client, what's your net worth? No one can answer me that question. I ask every single client, what's your body weight? They can answer me. So it's about how do we actually start to measure what we're doing, tracking what we're doing, and just that one strategy of the 10, instantly now we're starting to move forward. So I've got a nice little bonus for you because you're investing your time here. We're going to give you a bonus at the end of this, and it's going to help with the tracking of all your money. So this here is a video. It's super raw footage. I want to apologize. No one's wearing any makeup. No one's reading a script. It's literally just me in my clients' homes with a phone asking them how this payoff early system has helped them. So I apologize for the rawness of the footage, but it is real.
We're paying within time got the loan what we were paying earlier.
Having my bills paid automatically, I don't worry about money anymore.
We paid 50,000 off in 12 months.
50,000 after 12 months.
As opposed to 23 in 12 months from the previous year.
It's very easy to do. I found it very manageable. Now I've just about paid it up.
And we knocked the 107,000 off
In 1 year.
in 1 year, which is obviously a direct result of us coming on board with you some 12, 13 years ago, I think it is.
We're a lot better off now than what we were 2-3 years ago, and it's, yeah, I just think it's great.
If you're at the start of it, take the leap. I was really nervous because I've always worried about money. From the first month,
I saw us take off more than we were taking off in like 12 months prior to that.
And since we started that, we've, as we see, we're from 320,000 to basically 100,000 in 4 years.
12 years we've been with you.
Yeah.
We had one property.
Yes.
We have 4 properties and a amazing lifestyle. And you're going, how did it happen with you? You know that happened. And we tell other people, we're going, you need to ring, need to, and they're going, but how can this work? Because we've been brainwashed and this is the new way of doing it. You know, you actually want us to prosper.
We had people that were your clients told us about this 5 years ago, and we were just we were stupid. We should have done it then.
I think my last sticker said about $8,000. Wow, $8,000 off for that month.
$8,000 off the principal.
Yep.
In 1 month.
1 month.
12 or so years ago when we first sat down, I said, you're gonna knock $100,000 off your mortgage in 1 year.
I believe you.
I want to see bullshit.
So that is real. I mean, I you can't fake that. They're just real people sitting there telling you how this pay off early system has worked for them. No one's reading from scripts, as you could probably see there. So that system that we've designed, so I design loans. So I've got wholesale funding lines from the major banks, 2 of the big 4. And so what happens is we design loans that are there to get that mortgage paid off in under 15 years and are closer to 12 if we can. And so what this really just means for you is rather than having that 30-year loan, it's a 12-year or 15-year loan. And that means that you've got 18 years of no mortgage payments to pay back to your current lender. And so that free cash flow, when we start to look at what you can do with that, once you do pay off your house, is what sets you up for the most comfortable retirement that you could imagine, where you don't have to worry about money anymore. Quite regularly, I'm saying to clients, we do all the projections, we've got all the graphs, we've got all the forecasting software. If you just keep doing exactly what you're doing, you'll be able to retire at 60 years of age, and you'll never be able to spend all the money you've accumulated before you pass, which is the name of the game, right? And so we're very big into setting up the kids. What do we do to set up the kids? We have full strategy around that. How do we help them? But starting now, letting that compounding interest start now for the kids is absolutely vital. So with that, it's not just this one loan. Everyone's thinking it's a one loan. It's a system. There's 10 parts to this system. And when all those are combined, that's what gets that uplift. And so we're helping in so many different ways, which we're going to run through in a second. This is just another client of mine, once again, not wearing the old makeup, pretty raw, very Australian. And so these guys here paid off $294,000 in how long? If you want to have a guess at it, how long do you think it'd take you to pay $294,000 off? Average Australian's doing $10,000 per year. Based on those numbers, it's going to be a little faster. Watch this. $94,000 is what your balance was in January 2020, and you paid that down to 0 by January 2024.
That's unreal.
Wow. Now I am super impressed.
Yeah. And so, do you know what you've just done there?
No. Something awesome.
Yeah, you've paid $294,000 off your income in 4 years.
That's unbelievable, but we wouldn't have been able to do it if it wasn't for you.
Yeah, that's for sure.
I appreciate that, but you guys have just worked so hard. You've stuck to this strategy, and $294,000 off your home loan. Like, does that seem believable? I mean, who say it?
No.
There's no way in the world we thought we'd be able to do that. No way.
Jan had a bit of confidence in it, but I was always sort of reluctant to, something will usually come up or something and it holds us back a bit.
Yep.
Yeah.
No, I was determined.
Yeah.
There we go. Crazy. So this is what we're going to run through: how to pay off the house in 12 years, how to set the kids up, how to retire debt free, how to get 12 years. Sorry, I think it just popped out there. So lesson number 1, paying your house off in 12 years. How do we actually do that? Well, first and foremost, we need to understand the banking system. It's stacked against you. Banks like casinos, the house always wins. And so they make huge amounts of profit. Surprise, surprise. 80% of every dollar you pay to the loan every single month is going in interest. It doesn't come off your loan. And you're looking at the wrong number. You're looking at your rate. The banks are looking at the total interest cost. What's a profit in this loan for them? You don't unfortunately have a system to track or measure your progress. You can't tell me your net worth. You can't tell me your savings rate. You can't tell me your debt-free date. And so you're flying blind. You don't know how much fuel is in the tank, what altitude you're at. And so another sort of one of my beliefs, which I've just seen time and time again, is if you're not paying your income directly into your loan account, you'll never own your home. Now, that is a general statement. There are exceptions to every rule. I'm talking about the absolute average Australian there is unfortunately sort of running around with this offset account, thinking it's going to help them pay off the house. And we'll show the data on how little that moves the needle there. So this is what the big four banks made, $32 billion in profit, $32,000 million after expenses. CBA doing great at $10.2 billion there. So, I mean, we're in cost of living crisis. Things are tight. Everyone's sort of struggling. And these guys are just tapping 10,000 million a year in profits. Just horrific. Pigs, disgusting, greedy pigs. I don't like banks. You're going to pick that up. And so that is, it sort of it annoys me. I want to fix it. How much you pay off your loan every year? Here we go. What you want to do is look at your current loan amount. And so the average client we're speaking to at the moment has a $600,000 loan amount. That's about the average in Australia. In terms of the interest rate, they're looking around about 6.3%. And in terms of repayments, everyone's sort of ranging from 4.5 up to 5,500 per month in repayments. Some clients that are down at 3,500, depending on what you're able to repay. If you're looking at these numbers here, $600,000 home loan debt, 6.3% rate, and 3,500, you've got 90% of your actual repayments going in interest. If your repayments 4,000, it's 79%. That's the average. That's where most people are, is around about the 79 to 80%, which means they're paying $10,000 per year. And so I'll run through these numbers. You've got a $600,000 home loan. You've got a 6.3% rate. You're paying 4,000 per month. That's 48 grand per year after tax going towards the bank. Of the 48,000, 37,000 evaporates in interest. And what that means is you're only paying 10,000 a year off your principal. If you're only paying 10,000 a year off your principal, that means after 1 year, your debt's down at 590. The year after that, your debt's down at 580, and then 570. And guess what happens in 3 years? On average, Australians will refinance every 3 years to find a cheaper rate. Their bank or broker will reset their loan term back to the start of another 30-year loan, 30-year marathon, and you'll go through the motions again. And so that's why most Australians are retiring with a mortgage, is because they're refinancing every 3 or so years to find a cheaper rate or consolidate some debt, but they're resetting the loan term back to 30 years. They're going back to the start of another 30-kilometer marathon. Now, one thing I know is if you're trying to run a 30-kilometer marathon and you keep going back to the start line every 3 kilometers, I don't think you're going to finish a marathon. So that there is the numbers that no one's showing you, that you need to be aware of. And this is the most important number. Everyone's looking at this, 6.3, irrelevant. This is the number that we need to look at. How much is coming off our principal each and every year? So what's going to happen there is you're going to see that the amount of principal in your loan, or that's coming off your loan, is very, very minimal. The most I've ever seen was a client actually paying around about 33,000 a year off their principal. That was like unbelievably impressive. But for the average person I'm seeing every single day, 10,000 is the number there. So I will get that calculator out to you guys, and then from there you can see exactly what your numbers are. And if it's not anywhere near that $20,000, $30,000, then you definitely need to be having a look at some other options, because what you're currently doing, you can see, you've tried it. You're on the cheap rate. You're on the offset account. It's like, this is not moving. It's not designed to move. Banks are designing them to stay in debt for 30 years, pay off 3 years later, refinance, you pay off 30 grand, go back to the start of another 30-year marathon. And that's the treadmill that we're all on. That's the frustration that's coming out. It's because no one's wanting you to be paying off the house any faster than what you currently already are. Okay. So how do banks make money? I don't know if you know that your money doesn't sit in your bank account. Your money does not sit in your bank account when you bank it in there. It's relent out to other customers. So as a business, they're getting people's salaries, people's savings. A lot of them are putting them into transaction accounts, Visa debit accounts, whatever you want to call that. And they're actually paying them 0.01% interest on any money sitting in the savings account. 0.01% interest. That is nothing. Then they on lend that to other customers for home loans, car loans, personal loans, credit cards. So you've got all this money coming into these accounts. They're paying 0.01% out and they're receiving 16% in. That is a genius business model. You thought your money was sitting in your savings account waiting for you to take it out of the ATM. No, it's not. They re-lend it straight back out. And so that's how you make $10,000 million per year. You get money for free and re-lend it out at 16%, 7%, whatever it may be. So that is something that you need to be aware of. Any money sitting in your account isn't actually there. It's being re-lent out to other customers. So the simple answer is, how do we get our money working harder for us? Now, you've all got offset accounts, I assume. Money goes into the offset account, offsets the interest. That's cute. However, it's not going to help pay off your house in 12 years. And so as a result of that, the reason for it is the offset account doesn't really get going until the 15-year mark. No one holds their loan for 15 years. They're all refinancing every 3 years, remember. And most Australians, general statement, most Australians are spending and nibbling into money they have access to. And so if you've got 50,000 in an offset account, I can assure you most Australians at the end of the year might have 45 because they've sort of, oh, we need the couch or whatever it may be, they've justified to themselves. So you may not know this, but some of the banks forget to offset the money in the offset account. ANZ charged $25 million for misleading customers. We forgot to offset your offset. NAB, 5,000 customers forgot to offset the offset. How are you going to know? Hey, you're not doing your numbers sitting there with your calculator every weekend going, wow, that offset's correct. You're not. And they know that. And they get caught out every now and again. So this is an offset account. Standard $600,000 loan, sitting there at 600,000 on the balance with 60,000 in the offset. So you've got a 600,000 loan and you have 60,000 in the offset account. That will smash a 30-year loan all the way down to 24 and a half years. 24 and a half years, not going to change your life at all. I'm sure you assumed if you had 60,000 cash in your offset account and you never touched it, it would be getting a lot bigger return than that. And the reason for that is this 15-year mark. Remember, I said that's when the offset account really starts to take hold, but everyone's refinancing every 3 years. Every 3 years, people are resetting the clock and their bank and broker is wanting to do that because every time they reset the clock, they go back to the start, they get paid again. And so this is a game for brokers. They paid a trail commission. What's a trail commission? It's a percentage of your loan balance. Every single month, your broker is getting a percentage of your loan balance. What don't you want the client's loan balance to do if you're getting a percentage of it? Go down. Wow, that's fascinating. That's what the banks also want. So no one in Australia wants you out of debt because they get a pay cut or they receive less income from you. Everybody's financially incentivized to keep you in debt. And so you'll say, oh, Scott, why are you wanting to help people get out of debt? Two reasons. One is I feel that when I help people get out of debt, they tell more people. That helps me. I help more people. Second thing is, as people pay down their debt, they're paying 30, 40, 50, 100,000 a year off their principal. They create equity in their home. A lot of them start thinking, maybe it's a good idea to invest so I can start to set up my kids. And then from there, usually with that, I get to be paid again. So the better my clients do, the better I do, the faster I get paid again. And it's all one happy family. This is what an average offset account looks like in 10 years. You start at 500,000. In 10 years, you owe 400,000. My clients owe 180,000. Standard offset account, 10 years from now, 100,000's come off. With the way I set it up on the payoff early structure, we're sitting at 180,000. This here is that's obviously not a great still, but this here is a client of mine called Sheena. Tell me if she looks happy that, oh, this is my debt-free call. You know, I said to do these every month, every 24 days. This is Sheena on a debt-free call, and happy is, I think, one word to describe.
$19,000 off in 10 years.
That is incredible.
Wow.
That is incredible. Like that's the average Australian pays 9,000 a year off, and you're doing 21,000 on average, obviously. So like that's 200% better than the average bear. And I mean, you don't earn huge income. You know, you're not on like massive, like $200,000-300,000 a year mining income. But today you are debt free for the rest of your life.
Yes.
Free from mortgage. Bye-bye. Hey Dave, congratulations, mate. Mate, you should be having a case of beer, not just one, big fella. You're debt free. One beer is not way to celebrate, but
So, how are we doing this? Great question. Great question. How are we doing this? What we are able to do with the way I've designed the loans is flip the script, do the exact opposite to what you've been told to do. What does that mean? That means that you were told by your bank and broker to get your salary, put it into an offset account, pay the mortgage, or get your salary, put it into a savings account, pay the mortgage, weekly, fortnightly, etc. That is not working. That is why you're on the call, because you're doing that on a cheap rate. And so that strategy, refinance 30 years, refinance 30 years, is designed to make the banks and the brokers as much money as possible. We need to do the exact opposite to what everyone's telling us to do. And I know you're thinking, well, why isn't everyone already doing this? Because no one profits from it. So what do I mean? We need to reverse the flow of your money. Rather than banking into the offset account and the transactional savings account and paying the mortgage, we need to flip it and do the exact opposite. So we need to channel the income directly into the mortgage. We then have all of your bills direct debited out of the mortgage. That's what a lot of you thinking, oh, yeah, I can do it. No, you can't do that because the loan hasn't been designed with your current bank to be able to do that. So we have a premium all-in-one account where we have all of the income hitting the home loan account. Every single bill we have is direct debit out of the home loan account, gas, electricity, phone bill, insurances. Then we separate our income from our living expenses, critical. We have a separate spending account, Visa debit account. Bankwest is the one I use. They give you frequent flyer points for all the spending on a debit card. What? A debit card with frequent flyer points? Yes. So you don't need to be using, there's no credit cards on this system. So you've got a Bankwest Visa debit card. That's my spending account, and my food, fuel, and entertainment is sitting in there. So that's basically, for most clients, 700 to ish per week covers food, fuel, and entertainment. Then from there, all the once-off payments, etc., coming off the holidays or birthdays or Christmas, money sitting in my home loan waiting for that. And then when I require it, it's then in my spending account. I pay for the holiday, I pay for the Christmas presents, the birthdays, the clothes, whatever it may be. But just by reversing the flow of that money is one part of the 10 that we're going to be able to start to eat into the principal first. That's where everyone's going wrong. You're paying the interest at the front. We want to smash the principal as fast as we possibly can to drop the interest costs, to then accelerate that snowball. And like your super, where it's compounding, your super is getting interest on interest, that's why it's growing, is your mortgage is reverse compound interest. Every single month as the debt comes down, the repayment comes down. As the repayment comes down, means you have more money coming off the principal. And so your mortgage is reverse compound interest. When we hit the principal hard at the start, that snowball gets momentum and grows and grows and grows. And so every single month, our clients' debt repayments come down because their principals come down so rapidly. And so the numbers look a little like this. We're into you wanting the cheapest rate. That's what you've been trained to want. That's what you've been trained to look for. You're looking at the rates. You're looking at the wrong number. You need to be looking at this. How much money is going to come out of my account post-tax to own this home? That's the number you need to look at, not the rate. Look at the total interest cost. So your mindset is, if I want the cheapest loan, I'm going to ask for the cheapest rate. No. If you want the cheapest loan, you ask for the shortest term. The shortest term is the cheapest loan. So everyone's over these 30 years, I think they're even talking about 40-year mortgages now. And so what's that mean? Every single 3 years when you refinance, you haven't saved money just because your rate's cheaper and your payment's gone down. You haven't saved money because you're paying more interest over a longer period of time. That's what you need to understand, is that every single thing you've been doing, like, yeah, actually, I have been doing that. Yeah, you're right. I haven't actually got forward on my mortgage. Some people owe more on their mortgage than what they originally took out. So we need to start doing the exact opposite to what you've always been told to do. Otherwise, you're going to keep getting the same result you've got. Sorry, I'm a little passionate about this because I just know what a difference it's going to do to your life when you zig when everyone else zags. You keep doing what the masses are doing, you're going to get the results the masses are getting. Do the opposite to the masses, you get the opposite result. This is the result. So, clients, 41, 43 years of age, $600,000 loan, 10,000 in income between the two of them, both working. Doesn't really matter too much if they're both working, but that was this client. 4,500 in living expenses, food, fuel, fun, bills, holidays, childcare, schooling, everything. No loan repayment, just 4,500 in living expenses. Repayment 31.25 per month. First year, the worst year, they took 28,000 off their mortgage. Remember the total interest cost calculator I showed you? How they were doing 10,000? They were doing 10,300. 12 months later, 28,500. Same income, same loan amount. What do we do differently? 10 different things. But more importantly, we reverse the flow of the income. So that 28,000 comes off the principal. We're at 571,500 in the second year. We have income come in 10, expenses go out 4,500. That leaves us with 5,500. Take 3 for interest, leaves us with 2,500 times 12, 30,000. In 2 years, we got $58,000 in equity or savings, whatever you want to call that. And look, every single month as the debt's coming down, guess how fast the loan's coming down? Very quickly. We're paying 28 grand off, 30 grand, 32, 34, 36 per year. In this last year, they're paying 62 grand off. Why? Because their loan repayment is only 276 per month because they only owe 53,000. So as the debt comes down, the loan repayment comes down, more money off the principal, and that's why this compounds out. That's how you save $400,000. If you go and see any financial planner and they're going to say, I'll make you $400,000, like, whoa, I'm all ears. This is how you save $400,000, which mathematically is exactly the same as making $400,000 because interest saved is exact same as interest made. That's net, by the way. If you made 400,000, you can probably lose 30% of it in tax. So that are the standard numbers. We'll run all your numbers for you. We've got this calculator and we can then start to see exactly what your numbers show and whether or not we can beat the 27 years or 28 years, however long you got left on your mortgage. That's what, if we can't beat it, keep doing what you're doing. We will be able to beat it. And if we can, this is the numbers and we project it out. It's okay, well, are we able to sort of acquire any more assets? What do we do when we have paid it off? So your bank's on the right, the Crown Home Ownership Plan, 14 years, debt-free and done. Another client of ours, this is all this year, by the way. All these videos are from this year. Like, it's not so over the last 23 years we've had these clients pay off the house. This is just the ones this year.
I paid 256,000 of our loan in 9 years.
Look at the smile. Like, that is freedom. That's a freedom smile. You don't get that smile elsewhere. So 256 off the mortgage in 9 years. Great, good going. This is my favorite part. This is called the Intra-Wealth calculator. What does it mean? It means when you pay your house off in 14 years, you now no longer have a mortgage repayment. If we invested just half of the saved cash flow into whether it be your super, index funds, shares, whatever, there's so many different things to invest in. If we just invested half of the cash flow that you no longer had going out in mortgage repayments, then that's $2,750. That there invested into the age of 67 will mean you have another $462,000 in retirement just because you paid your house off faster. And that's what people don't understand is they think, okay, I'm going to just pay this mortgage off when I retire. I'm going to use my super. Most 60% of Australians are using their super to pay the house off. That means their lifestyle and retirement just evaporates, and they're on a pension, which is $500, $600, $700 per week. That's existing. You're not living. But this is the power, and this is why we're so passionate about getting you debt-free faster, because as soon as we do get you debt-free, that's when we go into the muscle program or the strengthening program. We've done the weight loss, and we start to build the asset base. And so to build another $462,000 in retirement like some people's super is not even $462,000. That's on top of. And so that's having the house paid off 10 years earlier and what that money can do, and that compounds out, and it's an unbelievable story. That's, by the way, based off a 4% growth rate, conservative. So a lot of my clients are paying too much in tax. It's something where we do a debt recycling strategy, and what that really means is we want to make sure that as we're paying the mortgage down, by 30 grand a year, 50 grand a year, 100 grand a year, we then recycle that money that we've paid off the house, we redraw it and put it towards investments. And so what that does, it turns your home loan into a tax deductible debt. So let's pretend we had $600,000, we had 30,000 come off the debt in the first year. So that's 600,000, we now owe 570. We then recycle that 30,000 we paid off in debt reduction and invest that. That means 100% of the interest on that 30,000 is now tax deductible. And we're growing our net assets because our assets are going up, our debt's coming down. When your assets go up and your debt's coming down, that is how you get an increase in net worth. So this is just a sort of visual of it. We've got the home loan here. As the home loan's coming down, your investment loan's going up, and your investment portfolio is growing over time by more than the interest that you're paying on the investment loan, because it's obviously tax deductible. So that's a strategy which a lot of our clients have used very effectively to accelerate their retirement, retire not only debt-free, but with more money than what they can spend before they pass. So that's a very quick snapshot. Summary was to have all income going to the mortgage, separate your living expenses, have all your direct debits coming out of the mortgage. This is that premium all-in-one account I've designed. And then from there, we just have that clarity and that tracking. Incredible. So thank you so much for tuning in. If you want us to run your numbers personally, you want a session with us or the team, let us know. We'll plug that in and see what magic we can create. But thanks so much, and we'll talk soon.